So we have this inflation, this reflation trade very much being expressed in bond markets right now, the highest in some 2 years. But 2 years ago, we weren't talking about runaway inflation. So just how much inflation should we be expecting to see, do you think, in the US?
Good morning and Happy New Year. I think the financial reflation story has further leg to run. It's, of course, understandable that at the time of pandemic, credit demand in real economies is going to be depressed, so that traditional understanding of monetary reflation is still some way contained. But what we do have is central banks setting the foundation here for a future reflation really taking hold, which is what the market being discount mechanisms of future expectations are now pricing in. And we can see this across a number of sectors. We've seen this in the resilience of capital markets in the past 12 months, that pickup in M&A activity that you just picked up in the previous conversation. And that's despite credit deterioration in real economies. We've seen this in the resilience of housing markets, despite rising unemployment rates. We've seen this in the prevention of a new financial crisis in Europe, critically, despite that astronomical rise in debt piles, particularly in places like Italy and Greece, of course, the most vulnerable borrowers. And we've seen this in the financing of record transfers of direct fiscal stimulus to the tune of some 10% of GDP or more if you include credit guarantees and government liquidity schemes into real economies in record times. I mean, in the short term, we have central banks preventing a depressionary shock in private sector collateral valuations and, of course, foreclosing that risk of a premature political discussion about government fiscal tightening. We're nowhere near that at a time when borrowing costs are so low.
Well, how close are they going to...
And central banks have been successful, yeah. Mm-hmm.
How close will central banks come to retightening then, Lena? I mean, if we do see inflation creep up, if we do see the 10-year yield get up to 150, 175, 2%, how quickly will the Fed be to act?
Yes, I think this is a key point, of course. And in the short term, the answer from financial markets is unanimously not close at all. I think that the Fed has engineered an admirably successful reflation strategy. It's visible from the universal US dollar weakness in the last 3 quarters. It's visible in the S&P volatility decay, in the rise of 10-year break-even rates, as you mentioned, towards 2% and higher now. I think, and that backed by the strong correlation between break-evens versus real yields, or indeed between gold and US 10-year real yields, or indeed in the reflation of Bitcoin. I mean, every single segment of the market is telling us that there is an excess, a financial overhang of inflation that's just waiting to ripen as we move out of the pandemic. And I do expect that 2021 will be the bounce back year. But with respect to how the Fed will react. I mean, the Fed's already mapped out in its staff projections that the gap between U.S. nominal GDP and 10-year risk-free rates in the U.S. is only going to get wider, which is a strong cyclical impulse for risk assets. And it tells us that the Fed, at the zero-rate bound, is more likely to prioritize market stability rather than inflation stability. So further yield curve steepening.